I want to show you my latest strategy. It's a new strategy and it's based on gold flash. I like that strategy, and it trades the currency. So here it is in the euro currency. We clicked on this middle chart, looking at the continuous contract at EC, and you see 32, 643.75, no slippage or commission. It's a counter trend strategy. It's long only, and you see 92.74 average trade profit. Minus 39.50 drawdown, and here is the equity curve. So nice equity curve. This strategy works back about the last 28 months, 2 years and 4 months. It does not work as well before that, and so falls into the new and emerging patterns, and so there's room for those in our portfolios as well. You could jump in on a strategy like this in 2017. You see that it's up 11,275 with 91 trades. And the drawdown let's see what the drawdown is in 2017. I'm going to pause the video and change the date. So in 2017, the drawdown is low, and you can always get in on a strategy like this and risk the worst case drawdown. Worst case max trade to close drawdown is 1106. Sometimes it can go below that. I mean, in the past it's gone below that, and it's worked the last 2 years and 4 months, and so you should expect a little bit more wiggle than that in the future, just based on the way markets change and the way strategies change. And so, how has it done in the yen? So let's test it on. We tested it on the yen. Good results on the yen, not as good as the euro currency. Euro currency seems to do best on most strategies. Here is the equity curve, and the drawdowns. The long-term drawdown is a little bit lower. Average trade profit is lower. How about the Swiss franc? The Swiss franc, 97 average trade profit. Very nice for a Swiss franc strategy. These are day trade strategies too, by the way. And low longer term drawdowns. Here's the equity curve. You see the Swiss franc and yen are more of a drawdown recently than the euro currency. Euro currency is a little bit closer to its equity peak. And so that's the flash strategy for the currencies that I have. Looking at implementing those in the portfolios. New and emerging patterns, there's room for those in the markets. Let's take a look at some longer term patterns. A long-term pattern that I have is Cobra 3 E-mini S&P, and I recently switched this in the past year to 15-minute charts using the same exact parameters. And so the strategy's been around. The application on the 15-minute chart has been around about a year, and so it's a trend strategy. And here is the long-term equity curve of this strategy. Again, the rules were developed back in 2009. It started in 2005, and the rules were developed in 2009. Application of it on 15-minute charts has been only in the past year. So you see the equity curve without slippage and commission. This is without slippage and commission. With slippage and commission, it's going to be higher. You see 58.72, 36.25 drawdown, and I wanted to show you NQ. Let's look at the NQs. We were going back to 2005 on this. We can go back to 1997 and get good results as well. And if you click on NQ, I want you to examine the average trade profit. Click on NQ. The average trade profit is 69, so it's higher, and the drawdown is lower. You get 58,000 here. You only get, well, this is going back to 2012, so let me update this. Let me pause the video and update this back to 2005. So going back to 2005, you see actually a larger drawdown and a smaller average trade profit. And here's the equity curve without slippage and commission. But what I want to do now is compare the last 5 years so you can see what it's done in the last 5 years. So I'm going to change the charts to go back 5 years, and you can see that the NQ will perform slightly better than the ES, and that begs the question, this is strategies in the portfolio, should we use NQ instead? And so I'm going to update that and show you the difference. So I've updated the charts going back 5 years. You see 66.53 average trade profit without slippage and commission, 2100 drawdown. Here is the equity curve, a little more choppy recently, but at equity peaks without slippage and commission. With slippage and commission, it would not quite be at an equity peak. And so you see the results here. Let's compare this with the NQ. Keep in mind The two things that I look at first on these performance reports is the average trade profit and the net profit as a percentage of drawdown. So watch those go up slightly. When I click on this window, the NQ, this goes up by $3, 69.27, and this goes up a little bit as well. And the equity curve is better more recently. And so you could consider trading both of these markets or one over the other. But you see, if you just look at the equity curve, you see there is a little bit from this point. This is choppier, and from this point, this is straighter. And so that's diversity. And I want to show you how I design portfolios. There's three ways that I design portfolios, and I use my portfolio calculator to do this when I combine strategies to get the results. So portfolio design is done three ways. I use old and new strategies. For example, Cobra has been around a while. Even if we make a small change like the time interval, that's still considered an old strategy on a new time interval. New strategies is Flash. Is the Flash strategy very new? Has a short track record. It doesn't test well going back as far, and so we've got strategies that do both. And then sometimes to maximize gains, we take sometimes strategies like old strategies. They may not trade as frequently in lower volatility markets, or the market might be more counter trend, and so we have new strategies. Use trend and counter trend. Cobra is a trend strategy, while Flash is a counter trend strategy. They are in different sectors. One trades the currencies and one trades the stock indexes, but one is trend and one is counter trend. And then we use strategies in a drawdown and strategies in an equity peak. The last thing you want to do is to trade a bunch of brand new trend strategies that are all at equity peaks. And so I don't think you'll have much success putting a portfolio together like that. You want to have some experience in there from your old strategies. Be in tune with the new strategies in the market environment. Have a diversity of trend and counter trend strategies, as well as different market sectors, different markets, diverse markets. And then you look at your strategies that are in a drawdown. You don't cut them because things are cyclical. And if they have a history of recovering, or if they're in a slight drawdown, you can get in on those. And then strategies that are in equity peak, strategies that are doing well. So I don't really want to trade a group of strategies that are all at equity peaks, or a group of strategies that are all in drawdowns. And so this makes a nice mix. And so that's the way I do it. That's just some of the considerations I take, some of the three main considerations I take when designing portfolios. And these are two examples of strategies that can be used in a portfolio configuration.